Okay, team, we're live here. YouTube, Robinhood Financial Market Update. We're taking the financial news that can be confusing, misleading, and take you off course, making it actionable, understandable, and clear. Article of the week, Wall Street Journal. Headline, Atlanta's record 62 million crowdfunding deal raises red flags with some investors. Subheadline, the buyer Nightingale Properties initially failed to disclose two loss-making deals, the investors say. So let's just define some things. What is a crowdfunding? You may be familiar with this platform. It's essentially a way for a lot of different investors to put in a little bit of money in a real estate context, buy one building. So in this particular case, it was an Atlanta financial center. And the actual operators group called Nightingale Properties. And so I see this all the time, just about every investor pitch deck, online, hard copy. There's typically really pretty data about past returns, which, whether investors will admit it or not, is the thing they salivate over most, because greed and fear are such powerful forces. That greed comes out when they see those historic returns. This article is a warning. So the article continues. This Nightingale, this New York City-based real estate firm, they actually, and they didn't disclose this on the initial information, they lost a Manhattan office building in 2021 to a lender, which means the investors probably got wiped out. The firm said it could no longer make mortgage payments. It also defaulted in 2012 on $25 million in loans related to retail properties in Tennessee. So these guys are everywhere doing everything. But here you go, devil's in the details. In both these instances and two others, the offering on the CrowdStreet website, that website that aggregates the money, it listed NA, not applicable, instead of the actual return, negative return. So what's going on here? Well, you, the investor, are not being given a fair shake, the true data. Now, upon being questioned, everybody gets defensive, both Nightingale and CrowdStreet. They go on to describe, well, it wasn't material, and whoops, maybe we should have, but it's not a big deal. CrowdStreet is supposed to be this guardian of the investor capital that's going to screen, curate these deals so that when the investor invests, they're not being hoodwinked. But they've got some conflicts of interest, because if you're CrowdStreet, you want as many operators as possible, putting many deals forward, because you are making a cut on the amount of money that's going through the platform. So what's the lesson? For me, and this may sound cynical, I really don't take a whole lot of stock in past returns at all. Not that the past returns, I mainly believe them, but I don't think it means a whole lot. So, for example, if you aren't an expert in a particular asset class or investing strategy and you see past return data, you might be inclined to believe it more easily. However, when you are an expert in a particular asset class or domain, Warren Buffett calls it a circle of competence, past return data could mean a whole lot of things. It could be just be attributed to a nice tailwind. Maybe the markets were favorable in that time period. Maybe the geography of the purchase was serendipitous and the return was excellent in that particular time. To latch on to past return data, I see it as a common mistake, and I think this article rightly shows just how valuable even that past return data can be. And in this week as well, and I'll be mentioning this on my podcast, mutual fund data, this week an article came out, is being monkeyed with. So people are actually changing the indices they are benchmarking their fund to if they aren't doing a good job. So when 1 week, there's a whole lot more of this stuff that just never gets caught, never gets sniffed out. A lot of investment folks are marketers first. So they are marketing to you. They know what you're interested in doing. So what's the answer? If you're not going to be looking for this past return data, how are you to evaluate where to allocate capital to generate a good return? Control what you can. If you listen to me before, you know what's coming. Your costs, whether you're operating within your domain of expertise or not. The index fund is great because it's a really big circle of expertise. You can kind of read 2 books, simple, well, yeah, you can read the little book of Common Sense Investing, Simple Path to Wealth. If you've read both of those books, I now would include you in you can invest in index funds. You may be a real estate expert, oil and gas expert, whatever the case may be, but handle your cost, handle your tax efficiency, handle your time frame, control what you can. Jumping in and out of investments based on past return is a recipe for failure. Believing past return data, as you can tell, it can also lead to ruin. So keep those costs low, keep that time horizon long, keep that investing simple. That's what's going to serve you best. Watch out, because these inspector gadget types were able to dig in and find the answer. I'm sure this was page 8 of the prospectus. This was not advertised. That may not be you. It may not be me. So keep it simple. It'll be best for you. Until next time.